Today is Friday, April 2nd, 2021, and I'm your host, Max Gottlich, and I talk about my interpretations and insights into financial markets and the global macroeconomy. Well, it's been way overdue for yet another episode of the Max Gottlich Show, and with the stock market closed today for Good Friday, here I am trying to explain to you the complexities of financial market plumbing. But before we dive into that, we should probably note that equities are continuing to make new all-time highs, which is compensated by the VIX, the volatility index, filling in that lower bound gap from pre-COVID. And of course, real interest rates are continuing to make higher low trends. You got the 10-year continuing to push towards that 2%. You have the 5-year break-even rate marking a decade high, and that's just another word for inflation expectations. You got, and to put really into context, you got the government debt to GDP still in excess of 100%, right? At like 115%. And Japan's government debt to GDP in excess of 200%, double that, like 225 almost. And today we actually got some stellar job numbers for the month of March in the US, where we created almost 1 million jobs. Really more like 916,000 jobs versus an expectation of 647,000 jobs. So we really beat those numbers really strong. And of course, we also got the unemployment rate today as well, which fell from 6.2% to 6%. In fact, personal bankruptcies are about half of what they were back in 2019, which is extremely, extremely positive news. But don't be blinded by the report, by the jobs report, because although it shows improvement in overall economic conditions, a lot of these jobs are furloughed, right? I mean, these are furloughed people that are just getting rehired, reemployed, and also the labor force participation rate is still very well below pre-pandemic levels. And with the many trillions in new spending and stimulus, the Fed better be careful with what they wish for in terms of allowing inflation to surpass that 2%, which they haven't been able to do for many decades. But it seems like this is just the tip of the iceberg for the Biden administration in terms of deficit spending. I mean, 25% or so of all US dollars have been printed just the past year alone. So at that point, what does 50% this year mean? What does 75% mean the next year? So it means that simply there's a massive depreciation ahead in dollar denominated assets. But remember, inflation is ultimately a monetary phenomenon, and people keep trying to compare today's artificialized economic boom to the roaring 20s, which is ridiculous because those are two totally different economic environments. In the 20s, the US was the largest creditor nation, but now we're actually the largest debtor nation, primarily due to an excess amount of spending and investment overseas versus domestically. So, really, the US has for the longest time been financially supporting other countries' economic prospects versus our own. So, let's shift gear here and let me actually show you the Fed's bond buying schedule on the New York Fed's website. If I could just stop sharing my screen here and get to uh, the here we are. Let's just bear with me here. Uh, okay, you should be able to see uh, the New York Fed's website here, the bond buying schedule. And I have highlighted here the uh, what hasn't happened yet in terms of bond buying. And you can see here what they're buying. They're buying coupons from, this is short term, this is long term, short, short, long, long. So, this is how much they're buying. You can see the rest. And so this is just a daily schedule of what the FOMC goes out and buys. And, I also took note here, and I'm going to read out loud for you just in case, or if you want to pause the video, I'm going to read it anyway. But this is kind of what marked the new regime in terms of modern monetary policy. Not modern monetary theory, but modern monetary policy. Well, yeah, they're essentially the same. And pretty much it's just an excess buildup of monetary purchases and new reform that pretty much equates to QE infinity. And so, effective December 17th, 2020, the FOMC directed the open market trading desk, or the desk at the Federal Reserve Bank of New York, to continue to increase the system open market account holdings of Treasury securities by 80 billion per month, of agency mortgage-backed securities by 40 billion per month. Consistent with this directive, the desk Treasury and agency MBS purchases will continue at their current pace and composition, and the existing purchase schedules for these securities released on December 11, 2020 will remain in effect. The FOMC will also directed the desk to increase holdings of Treasury securities and agency MBS by additional amounts in purchase agency commercial mortgage-backed securities, CMBS, as needed to sustain smooth functioning of markets for these securities. So that is real. Let's get back to the main thing here. That's really what we're talking about. That is what the FOMC buys on a daily, weekly schedule. And it's really just incredible because it's at such a large, unprecedented scale. And, frankly, some think that this is the tip of the iceberg in terms of how big the Fed wants to actually build their balance sheet. It's already grown exponentially, but again, some think this is really just the beginning. But that's really all I wanted to get into for today, and I hope you enjoyed. And also, please note, I'm not a financial advisor, and everything I say is entirely for informational and entertainment purposes only. Uh, Thank you very much.